Hey, I'm Jaden. On this channel, I break down the mechanics behind big market moves, options, volatility, the stuff most people skip over, no hype, just data. So this week we have some big earnings, Micron, Nike, and a couple of watchlist names, including Cerebras, which is reporting its first ever public quarter, and the options market is doing what it always does before earnings, inflating premiums way past what the actual moves tend to be. Micron options are priced 66% above the historical average move. Nike is 139% above. Those are the kinds of numbers that make premium sellers pay attention. What I am looking for every week is the gap between what the options market expects and what actually happens, when implied volatility prices in a 14% move, but the stock historically moves 8 or 9%. That gap is where the edge lives. This week, both of our main trades have that gap. Let me show you the setups. Micron reports after the close on Tuesday, the 24th of June. The stock is trading at $1,315, right at 52 week highs. This is a company that has been on an absolute tear. HBM capacity is sold out through all of 2026. All 27 analysts covering it have it at strong buy. Consensus EPs is $19.82 on revenue of $34.8 billion. These are massive numbers. Now look at Micron's actual earnings moves over the last 8 quarters. Minus 13.8, plus 23.8, minus 11.2, then it calms down. Minus 1, plus 4.7, plus 2.5, minus 1.5, plus 10.2. The average absolute move is 8.59%. Some big swings, but mostly single digits. That average is what matters for sizing the trade. Here is the key number. The options market is pricing in a 14.24% move. The historical average is 8.59. That means premium is inflated by about 66% above what actually tends to happen. That is a meaningful edge for selling premium. Not the biggest gap I have ever seen, but it is consistent. The market chronically overprices Micron earnings because of those occasional big swings like the 23% quarter. So the trade is an eye on Condor. Short the 1310 call, long the 1395 call. Short the 1030 put, long the 955 put. You collect 29.73 per second hair. That is almost $3,000 on a one lot. Your max risk is about 5,500. You need Micron to stay between 1030 and 1310 through Friday the 26th, based on the historical moves. That is a range the stock has stayed inside 6 of the last 8 quarters. Nike is the opposite story. The stock is at $45, basically at 52 week lows. Analyst fair value is $82, so the market is pricing it at a 45% discount to what analysts think it is worth. The headwinds are real though, about $1.5 billion in annualized tariff costs, continued weakness in China, and EPS expected to be down 21% year over year. This reports after the close on the 30th of June. And here is where it gets interesting. Nike options are pricing an 11% earnings move. The 8-quarter historical average is 4.61%. That is 139% premium above the historical average. This is the most overpriced setup on the board this week. The market is terrified of Nike because of the tariff uncertainty, but historically, this stock just does not move that much on earnings. The Nike Iron Condor, short the 50 call, long the 53 call, short the 41.50 put, long the 40 put. Entry credit is 86 cents, $86 per contract. Max risk is $214. The risk-reward ratio is not as attractive as Micron, but the probability is higher because the implied move is so far above the historical average. You need Nike between 41.50 and 50 through the 2nd of July. 2 names on the watch list that did not make the cut: FedEx. Expected move is 129% above the historical average, which looks great on paper, but the options are severely illiquid. The money call has a 43% bid-ask spread. You cannot trade that efficiently. And Cerebras' first public quarter, only 25 days of trading history. There is no historical baseline to compare against. Interesting to watch, but not tradable with this strategy. Quick risk summary. Micron is the bigger trade, almost $3,000 in premium collected, but $5,500 at risk. Nike is the smaller trade, $86 collected, $214 at risk. Both expire within the week of their earnings. The key risk on both is a gap move that blows through your short strike. On Micron, the 23% quarter from 2 years ago would have hit the Condor. That is real risk. Size accordingly. This is not a strategy where you go all in on one name. The earnings options market consistently overprices moves. Not every time, but enough that selling premium into earnings, when the math is right, has a durable edge. The key is picking the setups where the gap between implied and actual is wide enough to absorb the occasional blow-up. This week, Micron and Nike both qualify. I'm Jaden. Thanks for watching.